Janet Yellen also apologized for standing watch over $15 trillion buildup in the debt owed. I mean, basically, if you go back over the last 8 years, it's not quite a double, but it's pretty close to a double. And I mean, it was unsustainable then, and it's even more unsustainable now. And what they've done at this point is they've put the debt saturation and the fact that the debt service now is, and even at these low interest rates, and these are still low interest rates over the last 50 years, even at these low interest rates, the amount of interest payable on the debt is greater than the total budget each year for the U.S. military, which, by the way, is greater than all the defense budgets worldwide for the rest of the world. You can obviously, the way the system is set up, he can say that, and he can technically be correct, but they're going to be forced to print ungodly amounts of money supply, and that's a default because you're not paying back in the terms that you borrowed. You're paying back in dollars. Those are the terms, but you're not paying back with a stable dollar. You're paying back with a dollar that's, day after day, losing purchasing power. Right. Well, my thought process, very simply, was who's going to lend the money? I mean, if we're running a $2 trillion per year deficit, who's going to lend that money? And as we go further and further down this rabbit hole, foreigners, they've already started to back away, but foreigners are going to become outright big sellers. So who's the buyer? The only buyer, the only lender, it leaves you with the Federal Reserve. And I might add that if this wasn't the plan originally, they didn't think it through. But starting in 1913 with the Federal Reserve, where we stand right now is exactly where you could have modeled. You couldn't have modeled, the time factor or how long it was going to take, but you could exactly model where we are today as far as debt saturation and the interest payments eating up too much of the budget. Just one other thing, and I've spoken about this probably, 3 or 4 times on interviews now over the last month. The DOGE, Department of Government Efficiency, they wanted to cut 2 or 3 trillion out of the budget annually. And immediately when I saw that, my very first thought was, so you do a great job and you cut 2 trillion or 3 trillion or whatever the number happens to be out of the budget, and that money doesn't get spent. What happens to GDP? GDP gets crushed because all that spending is part of GDP. So if we've run, a trillion, 1.5 trillion, 2 trillion per year for the last 5 years, 10 years, whatever, if you took those expenditures out of GDP, we probably would have had a negative GDP for the last 10 years. Once they invert, then your risk of recession explodes. And once they uninvert, that's when the recession actually occurs. And we live in such a strange world today, Andrew. In Europe, your neck of the woods, Germany has been in a recession for what? Is it 2 full years now?
Sure. Basically
1.5 years, 2 full years. And where is their stock market? Their stock market's at all-time highs. So the point I'm trying to make here is that the stock market is not the economy. The real economy and financial markets are 2 separate entities, and they've figured out how to rig financial markets worldwide well enough so that you can have all-time highs in the stock market, a year, 2 years into a recession. I think that switch has already been flipped.
Wow.
If you go back, when was it, in September, when the Fed first started cutting, they've cut what is it, twice or three times, a full 1 percentage point is what they've cut. But what has the 10-year Treasury done from that day forward? The Treasury has gone up 1 full percentage point. So the point I'm trying to make is it looks, maybe it's too early, maybe it's not, but it's looking to me like the Federal Reserve has and is losing control of the yield curve. And that's dangerous. I mean, my thought process with gold and silver, the market is so much smaller. It's probably not even a tenth of the gold market. I've all along called silver the fuse to the golden nuclear bomb. You cannot have silver go into a default status and gold ignore it. I mean, it would immediately be followed by the gold market. You'd have buyers left and right, and I mean we're at the point now. Let me just talk about inflate or die, Richard Russell's famous saying. From a debt standpoint, because it's a Ponzi scheme, you have to continually create more debt to feed the Ponzi monster. If you don't feed the debt, then the debt collapses. So they're going to feed the debt. But when you feed the debt, what you're doing is you're expanding the money supply. So if money supply is going up 5%, 7%, 10, 11% per year, yet gold and silver production is static or slightly declining. What's happening is, it's the classic, too many dollars chasing too few assets. And it's that way, it's that way system wide, because GDPs are only growing worldwide at what, 2%? But yet money supplies are double, triple, quadruple that just to keep that 2% growth. So it's a dangerous situation. And like you said, when gold blows, confidence breaks, and that will literally blow up the entire derivatives complex across the board, which includes all sorts of commodities, all sorts of sovereign treasuries, equity markets across the world. The derivatives market gets taken down when gold becomes unavailable, to deliver. Like I said, you can't have a default in the silver market and the gold market ignore it. That cannot happen. Yeah, silver comes out of the ground at just under 10 ounces for every 1 ounce of gold. So God's ratio is, let's call it 10 to 1. Man's ratio right now is 88 to 1. For hundreds and hundreds of years, it was 16 to 1. So if God's ratio is 10 to 1, why did man settle on 16 to 1? And that's pretty simple, because years ago, 150, 200, 300 years ago, if you were going to transport capital or pay, you had to transport the metal. And because you had to transport 10 times as much silver by carriage, by horse, by whatever, man discounted silver because of the inconvenience. And I believe in the Constitution, the U.S. Constitution, it's 15 to 1 or 15 and a fraction to 1. And the world settled on 16 to 1, basically to compensate for the inconvenience of having to transport 10 times the weight, 10 times the size of what you could do with gold. Because there's been a concerted effort for 100 years to suppress the price of silver. Actually, you could go back to, I think it was 1897 in the U.S., when there was the big fight between the East Coast, the gold people, and the Western markets that were digging up a lot of silver. It goes back 125, 130 years, the price suppression. At this point, think about the uses of silver. I mean, there's so many uses. There's industrial uses, there's technological uses, there's medicinal uses, and now we've got the the green energy uses. So there's so many more uses for silver, and there's almost no uses for gold other than jewelry and reserves, bank reserves, or individuals holding it. So there's so many uses for silver. What if you woke up tomorrow morning and silver was $200? What would happen to a lot of the products, a lot of the uses that are in place right now? What would happen to those? Some of those, probably many, maybe more than half, those uses, the model wouldn't make sense. So, I mean, that would bleed through to the entire system, where you would see an inflation of all sorts of goods in all the uses for silver. Would that upset the whole system? I don't know, but I know it would certainly upset a lot of industries.